Hi, this is John Prasinos, Editorial Director of Investing Daily. Welcome to my video update for Monday, December 7. One of my favorite cinematic comedies is the 1984 mockumentary This Is Spinal Tap. You've probably seen it. It's about a fictitious heavy metal band called Spinal Tap. The band's leader utters a quote that has become a cultural meme. It's such a fine line between stupid and clever. I've thought of that line in recent days while watching the stock market rise. On Wall Street, the line is even finer between bullishness and delusion. Many analysts argue that the current rally has momentum and we stand on the cusp of a secular bull market. I mostly agree, although we're likely to experience sell-offs along the way, depending on pandemic news. To be sure, this bullishness seems counterintuitive, considering the precarious state of the economy and the exponentially spreading coronavirus. But I think the objective evidence gives credence to optimism. Robust retail sales, the likelihood of fresh fiscal stimulus, vaccine progress, loose monetary policy, pent-up consumer demand, and the denouement to election year chaos are paving the way for sustained upward momentum in equities. The three main U.S. stock market indices all finished last week in positive territory, with the S&P 500 and tech-laden NASDAQ both hitting fresh record highs several times. Take a look at the following table. Investors focused on brightening prospects for future economic growth and shrugged off the mixed data on jobs. The U.S. Department of Labor reported Thursday that initial jobless claims for the week ended November 28 came in at 712,000 versus 775,000 expected. However, the Labor Department reported Friday that non-farm payrolls increased by only 245,000 last month, far below the consensus estimate of 440,000. The November gain marked a sharp slowdown from the 610,000 jobs added in October. The national unemployment rate last month fell to 6.7% from 6.9%, meeting expectations. It's worth noting, though, that the headline unemployment rate fell because of a drop in workforce participation. Take a look at this chart. Sometimes on Wall Street, bad news is good news. Investors interpreted Friday's downbeat jobs report as positive because it increased the likelihood that Congress would act on stimulus. The month of November marked another substantial increase in market gains, with an expansion in market breadth. For most of 2020, the stock market rally has been disproportionately driven by large-cap technology stocks, raising concerns that a handful of big tech market leaders could drag down the rest of the S&P 500. But those fears are dissipating as other sectors and asset classes join the party. Take a look at my third graphic. A sign of a market peak is when fewer and fewer stocks are participating in the upswing, but we're seeing the opposite dynamic at work. This chart shows increasing market breadth, which is a sign of market stability. After a relatively slow September and October, this broad-based rally should continue into December and beyond as optimism over the economy outweighs worries about the virus. Talks in Washington on another coronavirus relief package have resumed, increasing hopes that stimulus will get passed by the end of the year. But until the pandemic is finally conquered, we won't experience full-throttle economic growth. There's no denying that COVID-19 remains a cloud over the economy and markets. However, investors already are looking ahead to an economic renaissance in 2021, when vaccines have stemmed the outbreak and a semblance of normalcy returns to public policy making. A reliable tailwind for markets is sustained monetary easing by the Federal Reserve. Fed officials last week indicated that the dovish policy of the U.S. Central Bank should continue into the foreseeable future. Well, as Walter Cronkite used to say, that's the way it is. If you have questions or comments, send an email to mailbag@investingdaily.com. Stay invested and please stay safe. Thanks for watching.